Hello everyone, welcome and thanks for watching the Market Report. This is Marcel Pechman, analyst and writer at Cointelegraph. Today's show will be debating the most pressing crypto topics, and it airs every Tuesday on the Cointelegraph Markets and Research YouTube channel. On today's The Market Report, we'll be discussing if Bitcoin is safer than the US dollar, considering the government default risk, plus why Bitcoin's 28,000 resistance will not be a walk in the park, and finally, what the hell is going on between Celsius, Ethereum, and Lido staking. Don't miss it, and make sure to like and subscribe the new Cointelegraph Markets and Research YouTube channel. We'll start by discussing an article written by Helen Pards. Bitcoin is a top 3 asset in the event of US debt default. Bitcoin would be a more popular safe haven than a US dollar, the Japanese yen, or the Swiss franc, according to a new survey. As US President Joe Biden prepares to meet with Congress on May 16 to discuss the US debt ceiling, investors are seeking hedges to protect their savings in the event of default. Gold, US Treasuries, and Bitcoin will be the top 3 assets should the US fail to raise its debt ceiling and default on its debt. Data from Bloomberg's latest Markets Live Pulse survey suggests. Okay, so let's be honest here. We all know that fiat currencies, the ones issued by governments, are kinda tied one to another, and that became more evident after the US Federal Reserve announced a special funding to the central banks of Canada, England, Japan, Eurozone, and Switzerland back in March 2023. So here's the press release from the Federal Reserve, date March 19, coordinated central bank action to enhance the provision of US dollar liquidity. Announcing a coordinated action to enhance and provision liquidity via the standing US dollar liquidity swap line arrangements. The central banks currently offering US dollar operations have agreed to increase the frequency of 7-day maturity operations from weekly to daily. The network of swap lines serve as an important part liquidity backstop to ease strains in the global funding markets, thereby helping to mitigate the effects of such strains of the supply of credit to household and business. So the central banks are all acting together using the US dollar as their main global reserve currency. That's nothing new here, but this agreement just exposes how those governments, especially the Switzerland one, which desperately needed dollars when they helped UBS and Credit Suisse during the banking crisis. So the US Federal Reserve said, don't worry, we'll give you some additional credit line. So whenever you need dollars, just shout to us. So you don't have to desperately buy those at the market. So those fiat currencies work all united. Those central banks, their intention is to keep the fiat money, this giant Ponzi scheme, working as longer as possible. So that's why they're working together. They seem to be enemies, they seem to be competing with each other, but the facts are they're not. They're working together. So no one in their right mind would buy euros or Great British pounds to survive the collapse of the US dollar. It doesn't make sense. Plus, it seems really odd the underrepresentation of stocks and corporate bonds on the Bloomberg survey. Both asset classes are a top 3 investment strategy in almost every mutual fund. Without further ado, here's the Bloomberg survey. What would you buy if the US hits the debt ceiling? The blue line is the retail investors, the black line is the professional investors. So 52% of them said they would buy gold, 46% of retail investors would buy gold. As for US Treasuries, nearly 15% for both classes. Bitcoin, there's a big difference with 11% of the retail investors willing to buy to add positions in case of the US hits the debt ceiling, while 8%, which is a considerable number of institutional investors, would be adding in the case of the near default of the US government. But there's a reason that investors did not say they would be buying stocks, the S&P 500, Apple, Microsoft, or wherever. Because 90% of the professional investors pool said they expect a 17% correction on stock market or higher in case government fails to raise the debt limit in time. So there's a Bloomberg material, the survey in 2011, the S&P fell 17% due to the debt limit standoff. This time, professional investors, stocks will get hurt but not as badly, 48%. Stocks will fall even more, 25%, so falling more than 17%. Stocks will fall by the same amount, 17%. Stocks will hold up less than 10%. So less than 10% of the professional investors think that the stock market will hold up. So that explains why they're not willing to buy stocks in the event of the US default. But there's no reason one should not be buying debt from multinational companies such as Microsoft, Google, ExxonMobil, Volkswagen, Samsung, Unilever. Firstly, some of those bonds, the corporate debt, are adjusted by inflation indexes. So a weaker dollar means higher returns because there's higher inflation, so the payout increases. Additionally, by having revenues outside of the United States, so in foreign currencies, those companies create a positive impact on their balance sheet when measured in US dollars. So if you're a bondholder of Unilever and the company has revenues in Europe, in Asia, in Latin America, when the company sends the money back to the holding company in the US, their balance sheet shows a growth in revenues when measured in US dollars. Anyway, the important thing is gold's preference among institutional investors is more than 6 times higher in comparison to Bitcoin, 52% versus 8%. But we can predict with a high degree of confidence that those professional investors' allocation to gold would be 10 times higher than Bitcoin's if we consider the asset's total market capitalization, because gold has 11 trillion and Bitcoin has 600 billion, so much smaller, and the stock price, the asset price volatility. So most portfolio managers, the large investors, are not willing to take a 20% exposure on an asset class that has 60 or 80% yearly volatility. It's too much risk for their portfolio. So their gold allocation can be much higher than Bitcoin's, even if the preference is only 6 times larger. On the positive side, 11% of retail investors would be willing to add Bitcoin in their portfolio in the event of a government shutdown, versus 46% for gold. In this case, their constraints for exposure in alternative assets is far lower. In a nutshell, the survey is mildly positive for Bitcoin, but it doesn't scream that the price will suddenly jump to $100,000 if the government shutdown takes place. Just to highlight, that's my own opinion and it does not constitute investment advice nor reflect Cointelegraph official view. Now, on to the next topic, written by myself. We'll discuss why Bitcoin's $28,000 resistance will likely prove harder than expected. 28,000 Bitcoin is in the cards, but it won't happen without a struggle. Professional Bitcoin traders displayed strength after the Bitcoin price corrected down to 25,830, favoring further bullish momentum. Bitcoin's price declined for 8 consecutive days through March 13, totaling a 9.4% correction. The last time such a losing streak happened was on June 2022, after the Celsius lending platform halted withdrawals and FUD emerged from the US software firm MicroStrategy loan being liquidated at $21,000, which turned out to be completely untrue. Nothing remotely similar happened as Bitcoin retested the 25,800 support on May 12, apart from the network congestion and increased transaction fees. Traders and analysts speculated that a coordinated attack was aimed at causing network instability. Regardless of the rationale behind the surging demand for blockchain space, by May 12, the average transaction fee had already dropped 83% to $5 from a 31 peak on May 7. Okay, so what the hell caused the 9.4% price decline? Most likely, the fear that Bitcoin network was under attack, causing transaction fees to remain excessively high for a long period. Although no one will ever know if the demand for token inscription on the Bitcoin network was orchestrated, it became apparent that hundreds, if not thousands of entities decided to take a shot on the multiple BRC20 token minting processes. That explains why, after 10 days, still today, the Bitcoin network fees remain above 3%. So the BRC20 is kind of a competitor to the ERC20 on Ethereum. So it's a kind of a very simple token that can be minted on Bitcoin blockchain. So there's a huge demand when they were launched because all the user had to pay was the minting fee, which was basically the network transaction fee on Bitcoin. So the token was given away for free. And there was a huge crazy demand for those in the start. Some of those are supposedly trading at $100 million valuation. So that explains why the increased fees during that period. The biggest point here is Bitcoin worked exactly as intended, and high fees are the network's own defense against spam. So it doesn't really matter how the block space is being used, as long as every transaction is paying fees for that. The problem holding back a quick recovery above $28,000 is professional traders positioning using derivatives. Prior to the event, those whales and market makers were already neutral to bearish. Firstly, there's the Bitcoin futures premium, which stood at 3% on May 5th. Those quarterly contracts usually exhibit a 5 to 10% premium in neutral markets, as sellers typically demand more money to withhold settlement longer. The indicator went down to 1% during the fee crisis, but it's now back to 2%, a neutral to bearish stance. Next, there's the Bitcoin options risk assessment, the 25% delta skew. The indicator flirted with bullish momentum as it touched minus 8% on May 5th, but it quickly reverted to a neutral range. Traders are now pricing similar odds of price pumps and crashes according to this indicator. The conclusion? One could interpret the whole movement as bullish, since the 10% correction was unable to flip Bitcoin derivatives metrics from neutral to bearish. Consequently, those betting on a bull trap, meaning a deeper correction lies ahead, will likely come out disappointed. On our third and final article, we'll visit Martin Young's take on Celsius moving $780 million in staked Lido Ethereum. It appears that the embattled crypto lender Celsius is wasting no time in shifting its Ethereum staking tokens from liquid staking platform Lido, which has just enabled withdrawals. The whopping stash was worth $780 million at the time of the transfer, which some believe is a preparation for withdrawal. Lido, which takes a 10% staking commission, enabled withdrawals on May 15 with a protocol upgrade to version 2. First of all, one needs to understand that Celsius was a ill-managed staking and lending platform that entered bankruptcy in 2022. There's a huge ongoing dispute between the creditors committee and the US trustee appointed by court. That's not unlike what FTX depositors are facing right now. So any on-chain transaction regarding those wallets raises lots of red flags. But the truth is, no one knows if those ethers will be sold at market and eventually paid out in US dollars for the Celsius creditors. For now, the potential sale of $780 million in Ether could negatively impact its price, especially consider those trustees hardly have the investors' interests at heart. Well, that's it for today. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!